Hello and welcome to this quarter's market update with me, Simeon Willis, and fellow partner Faye Clark, who's our Head of Manager Research here at XPS. We're going to draw out the key highlights from the first quarter of 2024 and share with you our thoughts for what the markets hold going forwards. Now, as the weather has shown us, spring is finally here and the markets have been looking up too. As we've become quite accustomed to, in the last few quarters, this market update has involved lots of good news, and this quarter was no exception. Equity market returns have been very strong, interest rates now look like they've peaked, and inflation appears to be close to being under control. But let's not forget, we've got some big events ahead of us, an election in the US and in the UK, along with many other parts of the world, and some disruptive technology in the form of AI, and the usual downside risks to keep sight of as well. So let's start where we often do, by looking at the detail of central bank activity and inflation. Faye, over to you.
Thanks, Simeon. On rates and inflation, I'm sure you've heard lots about this in recent months, so what is the latest? In the US, inflation remained higher than hoped, leading investors to pare back expectations of rate cuts by the Federal Reserve this year. There was initially talk of 5 or 6 cuts in 2024, but the market seems to have settled on the expectation of 3 cuts. However, at the Fed's recent March meeting, there was no change at all, and rates remain the same for now. This stance was mirrored in the UK, with rates being held at 5.25%. The good news is that the 12-month Consumer Prices Index, or CPI, fell from 4% to 3.4% over February. We're expecting the bank to wait until we move closer to the target of 2% before commencing any rate cuts later this year. Interestingly, there's quite a divergence in central bank action at the moment across different regions. Most major Western banks are getting close to cuts, with the Swiss National Bank being the first to do this, given they seem to have inflation under control. We saw the Bank of Japan go the other way, raising interest rates to modest positive territory for the first time in 17 years, meaning that there's now no country in the world holding negative interest rates.
Looking at the UK, we saw a technical recession with 2 quarters of negative GDP growth of minus 0.1% in Q3 and minus 0.3% in Q4. However, not all recessions are equal, and this current one is looking pretty mild. If we compare it to 2008, the global financial crisis, we saw 5 consecutive falls, totaling minus 6.5. So all of this provides a clean backdrop for strong performance in the equity markets. We've seen US, UK, Europe and Japanese markets hitting all-time highs in March. So what's been driving it? Well, computer chip designer NVIDIA has contributed around 20% of the growth in global stock market value over the first quarter. And the tech rally broadened out across the global equity market as the continued resilience of the US economy was cause for infectious optimism around a global soft landing. But for many investors, a strong bull run leading to market highs is a warning that a market correction may lie ahead. This is something I've written about separately in a blog, looking at some of the psychological traps when markets are running away with themselves, which you can find on our website. A key message is that markets being at an all-time high is not in itself a reason to call time on equities, because there's more going on. We're now going to move on to have a look at how credit markets have performed. Faye, over to you.
In credit markets for UK corporate bonds, the story remains the same as previous quarters, with spreads continuing to tighten, now at their lowest level in 2 years. This is positive for performance, which delivered a small return in Q1 despite rising gilt yields. Similarly for high yields, spreads have compressed substantially in recent months. We've seen quite a high amount of debt issuance at the start of the year, as we expect most are trying to avoid the potential volatility that may come later in the year around election time.
We're now going to finish with our outlook across the various asset classes.
In terms of outlook, not a lot has changed in our views from last quarter. Outliers to our neutral view are developed market equity, equity protection strategies, and high yield. On the more favourable side, we have developed market equity. With inflation falling, markets have been heading upwards and reacting well. We believe that if central banks navigate rate cutting cycles carefully, the market will continue to perform positively. Equity protection strategies are also looking better value. On the relatively unfavourable side, in high yield, we believe spreads are too tight to feel positive about this asset class just yet. However, we could see flows back into high yield if market confidence continues upward. The only one change to our view is tapering back our outlook for cash. Where we've been positive previously, we've moved to be more neutral, reflecting the possibility that rates are indeed peaking.
So with that, we've come to the end of this quarter's highlights. Faye and I hope that's brought you up to speed. And if you have any further questions, please get in touch with your local XPS consultant or check our website. That leaves it to me to thank you and wish you a productive spring.